Hello everyone and welcome to today's video where we'll be discussing secured versus unsecured debt. Whether you're new to personal finance or an experienced investor, understanding the difference between these two types of debt is essential to making informed financial decisions. First, let's define what debt is. Debt is an amount of money borrowed by an individual or an organization from a lender or creditor, which is agreed to be repaid over time, often with interest. It can be in the form of a loan, credit card balance, mortgage, or any other financial obligation that requires repayment according to agreed terms and conditions. Failure to repay the debt on time may result in penalties, increased interest rates, and even legal action by the lender to collect the debt. There are two types of debt, secured and unsecured. Let's start by defining what secured and unsecured debt are. Secured debt is a type of loan that is backed by collateral, which is an asset that you pledge as security for the loan. The most common examples of secured debt include mortgages and car loans, where the collateral is typically the property or vehicle being financed. The lender has the right to seize the asset if you fail to make your loan payments, which provides them with a level of protection against default. One of the key benefits of secured debt is that it often comes with lower interest rates compared to unsecured debt. Because the lender has collateral to secure the loan, they are willing to offer more favorable terms to borrowers. Additionally, secured debt may be easier to obtain for borrowers who have less than perfect credit, as the collateral provides a level of assurance to the lender that they will be able to recover their losses if the borrower defaults on the loan. However, it's important to note that there are some risks associated with secured debt. If you default on the loan, you could lose the asset that you used as collateral. For example, if you default on your mortgage payments, the lender could foreclose on your home and sell it to recover their losses. This can have serious financial implications and can be particularly devastating for homeowners who have significant equity in their property. In order to minimize the risks associated with secured debt, it's important to carefully consider the terms of the loan and to only take on debt that you can afford to repay. Before taking out a secured loan, make sure you have a plan in place to make your loan payments on time and in full. Additionally, it's a good idea to shop around for loans and to compare rates and terms from multiple lenders to ensure that you're getting the best deal possible. Overall, secured debt can be a valuable financial tool for borrowers who are looking to finance a major purchase or consolidate high-interest debt. However, it's important to weigh the risks and benefits of secured debt carefully and to make informed decisions when taking on debt. Unsecured debt is a type of loan that is not backed by collateral, meaning there is no asset that the lender can seize if you fail to make your loan payments. Examples of unsecured debt include credit card debt, personal loans, and student loans. Because unsecured debt is not backed by collateral, lenders rely on your creditworthiness and ability to repay the loan when deciding whether to approve your loan and what interest rate to offer you. This means that if you have a good credit score and a stable income, you may be able to qualify for lower interest rates on unsecured loans. However, because unsecured debt is considered riskier for lenders, it generally comes with higher interest rates than secured debt. This means that if you don't have good credit or a stable income, you may end up paying a higher interest rate on your loan, which can add up to a lot of money over time. Another disadvantage of unsecured debt is that if you default on the loan, the lender has limited options to recover their losses. While they may be able to take legal action against you, they cannot seize any assets as they can with secured debt. Despite these potential drawbacks, unsecured debt can be a useful tool for borrowing money when you need it. Whether you're looking to finance a big purchase, consolidate high-interest credit card debt, or pay for unexpected expenses, there are many types of unsecured loans available to meet your needs. As with any type of debt, it's important to make sure you have a plan to repay the loan before you borrow any money. This means creating a budget, cutting unnecessary expenses, and making sure you have enough income to cover your loan payments and other bills. Unsecured debt is a type of loan that is not backed by collateral and is based on your creditworthiness and ability to repay the loan. While it may come with higher interest rates than secured debt, it can be a useful tool for borrowing money when you need it. As always, make sure to borrow responsibly and have a plan to repay the loan before you borrow any money. Now that we've defined the two types of debt, let's take a closer look at the differences between them. One of the biggest advantages of secured debt is that it typically comes with lower interest rates than unsecured debt because the lender has collateral to secure the loan. This means that if you default on the loan, the lender can seize the collateral to recover their losses. Because of this, secured debt is generally considered less risky for lenders. However, if you're considering taking out a secured loan, it's important to remember that if you default on the loan, you could lose the asset that you used as collateral. This could result in the loss of your home or car, which could have serious financial implications. Unsecured debt, on the other hand, doesn't require collateral and is instead based on your creditworthiness and ability to repay the loan. This means that lenders consider your credit score, income, and other factors when deciding whether to approve your loan and what interest rate to offer you. Because unsecured debt is riskier for lenders, it generally comes with higher interest rates than secured debt. So, when deciding between secured and unsecured debt, it's important to weigh the advantages and disadvantages of each. If you have collateral to secure the loan and are looking for a lower interest rate, a secured loan may be the way to go. However, if you don't have collateral or don't want to risk losing your assets, an unsecured loan may be a better option. It's also important to remember that taking on debt should always be done with caution, and only when necessary. Before taking out a loan, make sure you have a plan to repay it and that you understand the terms and conditions of the loan. In conclusion, understanding the difference between secured and unsecured debt is an important part of making informed financial decisions. Whether you're looking to buy a home, finance a car, or simply need to borrow money, understanding the pros and cons of each type of debt can help you make the best decision for your financial situation. Thank you for watching, and I'll see you in the next video.